The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy.
On this episode of Pennies Going In Raw, we have a very special guest. It's Incredible Bob, someone who always shaves it off the top. And if you're shaving it off the top, we want you to do it with Manscaped. And Manscaped has a very special offer for you and also your father. And Father's Day is coming up soon. For 20% off and free shipping, use the code PGIR on manscaped.com. And like I said, 20% off and free shipping. You get great items. You shave your jewels. And you make sure your father's doing okay. Because, I mean, let's be honest. He's the one that got you in this world. This is how we got you in this world. So let's help him out. Let's go.
Hey, yo, check 1, 2. This is Flavor Flav in the building for the Atlas crew.
Atlas Trading, what the fuck is up?
There are traders, there are prodigies, and then there's legends.
We're up 4%, baby.
No way.
4 fucking percent.
Buy the fucking dip.
Hey, who told me about IDEX?
Like, dude, what the fuck? Like, someone just made, like, a lot more money than me on my trade.
You find out life's this game of pennies.
Did you check the portfolio?
Pennies.
The margin for error is so small.
I bet Warren Buffett never did that.
And they out there making money right now off of penny stocks.
Them two guys is putting in work to make y'all rich.
The pennies we need are everywhere around us.
It's time to think big.
Pennies Going In Raw.
Featuring Dan, Deity at Dips, and Hugh Honey.
Produced by Vinny Strokes, baby.
Today's episode of Pennies Going In Raw is brought to you by Benzinga. Benzinga is our absolute favorite resource to use to trade with. We use it for charts and news and scanners. Look, guys, we use it for everything except for buying and selling stocks. I mean, that's all there is to it. And if you're not using Benzinga Pro, which you can get for 2 weeks free at pro.benzinga.com. That's pro.benzinga.com. You should at least be checking out their YouTube channel every single day. YouTube.com/Benzinga. They have Hot Stocks Lukes and a just plethora of fantastic guests from me and Hugh to Mia Khalifa to Ripster to CEOs of companies to CEOs of Weeble. They have it all, guys. Make sure you check it out. That's youtube.com/Benzinga. And today we have on Incredible Bob. You know, everyone knows him. You love him. You've seen his tweets. You see him in Atlas. Thanks for joining us, man.
Thanks for having me. I appreciate it.
Hey, anytime. So we always just kick these off with your origin story, how you heard about trading, how you started trading. And I'm really excited about this one because it started a lot earlier than all of the other interviews.
It might have started earlier than some people were born. What is it, 2021? I think I've been trading for about 15 years, give or take, 1 or 2. I think I got into trading no different than anyone else. It was the opportunity to grow your wealth, to in essence own your research and to be your own business person. So you could I guess live the American dream, for lack of a better term. You could better your future. And it was enjoyable, and it still is very enjoyable. I've learned a lot over 15 years, plus or minus. But yeah, I mean, I think it's just the ability to own it and have fun with it, and to watch the work you put into it grow financially.
When you first started 15 years ago, so I imagine it's right before 2008. you get a couple years before the crash. Are you just doing this as like a hobby while you work?
Yeah, I think it was definitely a hobby. It was, I talked to folks who were doing it, and I think it's like anyone else. They, you just don't go into it blindly. You hear it through other channels, and I wasn't doing it back then. I think it was just the standard. Let me invest in a whatever mutual fund. Let my money grow at a real nominal rate. Let me take the safe road, and I don't think at the time. Looking back, it wasn't real risk adverse. I was much more conservative. And I said, let me go ahead and put some of my dollars, like probably 10 to 20% of it into stocks. So it would be much more risky. And so things were booming when I started trading. It was the real estate market was, out of control. This was right before, a couple of years before the Great Recession. So I saw this, massive uptick and everything, just insanity. And then, as you mentioned, it went from, this crazy uptick into this like holy shit scenario where literally the floor stopped or got pulled out from folks, and it was the beginning of the real estate pop and just the epic collapse of the global economy.
Are you seeing a lot of those same similarities now with like 2008? Do you kind of see another recession coming with how crazy like all these bubbles we're kind of in right now?
Yeah, I mean, you see some of the same behaviors. You can look back in history, and you can look at the history of the 1920s stock market bust, and you can look at human behavior and what people were doing and the exuberance around speculation. I think this is a little bit different from the Great Recession in that while Trump was president, he tore down a lot of the regulations that were put in place after the Great Recession. But I don't think we're as in a superior risk market like that was, albeit, there's always a hidden angle that, everyone has a great amount of hindsight. And saying, "Oh, well, I saw it, and I bet against the market," and it's very few people that are going to do that. It's always the hindsight commenters around that and the talking heads. So yeah, I mean, do I feel like the market's inflated? Yeah, 100 million%. There's no question. I mean, we're printing money at an epic rate that's not sustainable. And at some point, something has to give. There's going to be some failure of a stress test, and the market, will pull back. And to be honest with you, it needs to pull back. But there's always a vehicle to trade out there. You just have to be able to be nimble enough and be able to navigate to that said stock or that said theme that, and listen, if everyone's super long, then people become super short, and you have to change your technique. It's just about having multiple tools in the bag.
So making it through 2008, everything was booming, very similar to how everything was booming now. And then 2008 comes. How did your portfolio survive that? Were you already adapted enough and knew how to adapt your style to a falling market, or did you take a huge hit during that time?
No, dude, I got kicked in the freaking nuts like everyone else. I watched my mini 401k evaporate to basically nothing. I watched friends and colleagues you literally watch their entire life savings get wiped out in a matter of days, and it was frustrating, just to watch, just people in tears, and you learn, you're like, holy shit, I don't know if this is for me. But where there's, destruction, there's also opportunity. And so when the dust settled, it was a lengthy recovery. The recovery from COVID was a very sharp V-shaped recovery. And what we've experienced over the last year, it was not like that in the Great Recession. I mean, I was buying, after I kind of shook off the dust and was like, holy shit, just what just happened? Watching, me lose money and it's just totally not recoverable, because at the time I didn't have strategy. I just panic sold like everyone else. I didn't understand. I just watched my numbers, my portfolio go down by like 75% probably. And just literally just shitting myself going, oh my God, this is not for me. I'm just going to stay working, keep a cubicle life or whatever. But no, I think what I did see, and after I talked to some people, and I still had enough liquidity to weather the storm and go, okay, let me try this again. What I saw were name brand stocks like Ford and Citi and Bank of America that used to trade like in the 30s and in the high 20s. Dude, they were down to single digits. They were below $1. And so I was like, you know what? These companies aren't going to go away. They're going to get bailed out. They were already getting bailed out. I mean, if those companies vanished like Lehman did, there would be more than just bankers out of business. You're talking, the foundation of our country. They're gone. All anything from the steel belt to the rust belt, just gone and gone for decades. They would never come back. And so I was like, let me scoop up some of these stocks like a Ford. Let me scoop up a Bank of America, a Citi, a JP Morgan. And I did. I scooped up a lot of these value plays and I held them. And I held them for a long time. And I, did extremely well holding them. And I built a good book around that. But then while I did that, I started learning better efficiencies around day trading and better knowledge. And it was still difficult back then because back then you didn't have the technology that you have today and the things that are accessible that you have today. I mean, everything is at a mouse click today. That didn't exist back then. It was dial-up internet. It was, reading the Wall Street Journal, trying to kind of position yourself. Very rudimentary platforms and extremely high commissions to go in and out of a trade. So no freebies like we get them today. It was $20 in and $20 out. And so you really had to you had to think on how you wanted to navigate a day trade.
Yeah, I think that's an interesting thing is how many difficult things someone would have. Like there's so much ease of access now. What do you think are some of those things that, they just, a lot of new traders would be surprised about the difficulty from like 2005, 2006 trading?
Yeah, I mean, I know that folks use a lot of the word, I hear it a lot today, is gamification. And I don't know if it's gamification. I think it's ease of access. The playing field got a lot more level today than it was back then. You really had to do your homework. And it was very difficult to determine, what things would run. You didn't have, companies weren't putting their corporate presentations on websites like they are today that you can access. You had to do a lot of reading in the SEC documents. And again, the accessibility to that information was not as clean as it is today. And so definitely much more strategic back then. Today, there's a lot more fluidity. Like I said, it's for me, the playing field is a lot more level on the tools that the average retail trader can have against, some of the bigger banks and how they operate.
So you kind of mentioned how after 2008, you were buying all these cheaper plays that you figured would come back as kind of value plays. And these days, you're kind of known as a bottomed out bio swing waiting for catalyst. Was there any correlation and how exactly did you begin, finding that as your like key strategy?
So yeah, good question. Background in medicine. So I understand the lingo better than I would say that the average layperson does. Does it mean that you're 100% right on how you play those? No, you never are, because you never know how data from a trial or a catalyst is going to hit. But, I think from the bottomed out strategy, that's definitely something that I learned from back during the Great Recession, because all those stocks were bottomed out. And so you would look to potentially see, from an earnings perspective, you learn where the run-ups would happen. And I learned that, you learn that phrase, back then from the Yahoo message boards and various not chat rooms, but different internet message boards that existed outside of Yahoo. And there were other people, and I don't claim that as an original. No, I saw other people doing the same strategy and I wanted to figure out, and I asked them, what they were doing. And you learn over time and you master that technique. And for me, yeah, it's one of my bread and butter go-to techniques every time. Regrettably, in this market, since the January, February run of this year, a lot of those bottomed out biotechs don't exist anymore. They everything ramped up, and so I've had to adjust the strategy a little bit. There's definitely a little bit more risk involved, I believe, because the downside can be much more swift on some of these than the upside. But yeah, that was it still is a tried and true strategy. It doesn't change. You play a run up into a catalyst, whether it's earnings, whether if it's a biotech, whether it's into data proposed. You hear about sometimes a merger. You carry it through back channels. You play the run up, and it's never a guarantee of 100% success, but it has a high probability of success, and that's what I look for in a trade, whether it be a swing or a day trade.
Bob, do you think that there's any small cap bios out there that truly have a chance to be a disruptor and, in let's call it 10, 15 years, if, based on the way that they're going, could genuinely be like a $10 billion, $50 billion company?
That's a really good question. It's tougher to find those unicorns to survive in the marketplace. Healthcare's complex. There's a lot of things that have to be done outside of just drug development in a successful trial. There's a lot of things that happen in the background that the average person just doesn't fully understand. To become a multi-billion-dollar company is very rare. To be able to do it, the bigger guys will come in and they can snuff the smaller guy out if they choose to do so. And there's multiple ways for them to navigate and do that. They can literally choke them out of the marketplace. Is it the right thing to do? No. But does it happen? Yeah, I think that's it's apparent that it happens in the marketplace. That type of negative squeeze on competition. But that doesn't stop a company from developing a promising product and aligning themselves with, a big player like Pfizer. You look at Pfizer and I forget the name of the other company that they're doing the COVID vaccine. I just know the ticker, BioNTech or something like that, I think is the name. That's a smaller company, development company, but they partnered with a large pharma company to move the product. Obviously, because of COVID, and they have a very viable and successful vaccine. But that for me is more of the strategy, I think, moving forward for some of these smaller companies and micro cap biotechs that do have promising drugs. Some will try to go alone, and we've seen what happens when they go alone in the marketplace. They accrue an enormous amount of debt. They can't get out of the debt cycle. They want to then partner with a large pharma company or get bought out. That company doesn't want to touch them because the debt that they owe to the marketplace is more than that product or that they have will ever deliver. And so it doesn't make sense. So it's better for them, I think, in my opinion, to partner early on if they have a viable candidate. But there's a multitude of factors that go into bringing a drug to market outside of just a successful clinical trial.
So one thing you've been pretty outspoken about is, you always mention you won't give out your scanner. You put too much work into it. But what goes into making a good scanner? How did yours form over time? And how long did it take to form? I feel like you kind of or at some kind of advantage. I watched this one documentary of people that had to transition from trading in the pits to trading on the computers called Floored was the documentary. But you started right as, it transitioned to computers, basically. So the story of the scanner, I'd love to hear that.
Yeah, so I, through my broker, had access to a very old version of Trade Ideas. Never paid for it. It was just part of me being grandfathered in, which was fantastic. And so I always had difficulty with it, because I'm traditionally a swing trader, but by nature. I look at the long-term opportunity that a specific stock with catalyst, bottomed-out biotechs, as you had mentioned, present, and what's the potential run up. Again, have they done an offering? What's their cash position? What have they done in past, when they've had a run up into a prior catalyst? What's their behavior been, their culture? How have they acted in advance of that said catalyst? And so you kind of whittle those things out. And if it looks like, it's a clean play, that they don't do offerings in front of it, then, again, probability says they're not going to do it. Doesn't mean it's a guarantee. No, but probability says, hey, they're not going to do these things that would, whack the price back and then have me holding a bag into a catalyst. But then I also started messing around with the scanner, and because swing trading is 80% of what I do. But day trading still represents 20% of, cash flow for me. So I needed to figure out how to build these scanners and what worked best. And so, it's never a perfect science. And I think a lot of folks believe that, we joke around and call one of my scanners Toto. It's my accumulation scanner. I asked a couple people how they built theirs. No one really ever shares on how they do stuff. And so it was really just trial by error for me to build it out. And the thing is with the scanner, it's going to throw out an enormous amount of data at you all the time. It doesn't mean that every time that thing pings that it's a buy or a sell trigger. It just means, hey, something looks a little funky here and you kind of want to put your eyes on it. And it might mean something. You might have caught something, or maybe you don't. And so it's, again, I look for certain price levels. I've learned over the years, I look for certain tickers. There are certain tickers that are very cyclical. They work every so often. And so when those tickers randomly, you haven't seen them for a while and they randomly start hitting the accumulation scanner, you're like, oh yeah, something's going on here. Some insider might know something in the company that's starting to kind of scoop up shares. Is it a pump from a chat room? Who knows what it is? But if it hits that accumulation scanner, yeah, and it's what I call an anomaly. I write them down and I watch for them. Again, doesn't mean that they always work out, and doesn't mean that I buy them instantly. I just put my eyeballs on them. And then the other thing I do, is in the part of the day trading universe is also, it's the news feed. And the news feeds today are so much better than they've ever been. And there's a variety of them out there in the marketplace. You just have to find ones that work for you. But we've moved, since COVID, we've moved into a very aggressive day trading environment. So while I still do my swings, I'm a little bit more risk adverse right now because of where the market stands. But I don't position as heavy into some of the swing plays as I normally do. I will scale up or down depending where they go, as long as they hold within my levels of comfort and my ranges. But the scanner is definitely during market hours is really important. And then in the pre-market and aftermarket with with your various news feeds, it's sometimes the scanner will pick something up and I miss the news thing and I'm like, oh shit, there it is. I'm like, crap. And then you have to play the trade appropriately.
You mentioned 80-20 day trade, but you also mentioned how you have to day trade heavier now. Does that ratio kind of stay the same, or is it like in this market you've seen the past couple months, or is it more like 60-40?
Yeah, I would say it's more 60-40 in this market, probably heavier on the day trade side. I mean, ever since we had this crazy run, started in December, went ballistic in January and February, and about half of March, there was an enormous amount of day trading. Yeah, we were still swinging stuff, where I was. But I think what we saw in this 90-day period or so, we saw almost like the full calendar year of events that traditionally happen in the micro caps and the small caps happened in this like consolidated 90-day period, which is madness. I've never seen anything like that in 15 plus years. Never have seen literally having 5 stocks under $1. Like it was absurd. And it, did I trade my best during that time? No, I can tell you pointedly I didn't. Did I make money? Yeah. Was I successful? Yes. Did I maximize the opportunity? No, because I've never experienced something like that. So even when these things happen, I still have to have a comfort level to do it. And so, yes, there's a much more significant focus on day trading, I think, for me now, versus swing trading. But I think we're starting to creep back into this very nice swing trade environment. But again, I tell folks, I said, if your normal position size is 10,000 and I say, hey, I'm taking something as a swing trade, don't put all 10,000 of your shares into the initial, like, dude, let it fall back. It doesn't mean that I'm guessing the right entry point. I just see something I like and I want to dip my toe in the pool, but I'll scale into it appropriately.
You mentioned with like the how crazy it was with five stocks under $1 and everything. Was it kind of obvious to you that this longer or this 90-day downtrend was going to kind of happen for small caps and swings and stuff?
Yeah, it was apparent. We needed to relax. And the sad part is, as much as we've seen a necessary pullback from these extreme highs in an infinite amount of offerings getting bought up in companies that are truly trash, the market hasn't pulled back. And so there has to be a give somewhere. And this is kind of where I'm waiting. I'm sitting on a lot of heavier cash position than I normally do. And I mean, it's a very heavy cash position. I'm just waiting. Again, cash flow. There's multiple ways to trade the market. I think we need to be much more selective on the things that we do. It's not just this knee-jerk reaction that we had in the beginning part of the year. But yeah, I think this is what we're seeing is a necessary pullback in some of these smaller price stocks that just inflated at a rate that was unsustainable.
Do you kind of look at these downtrends and just lick your lips as a swing trader, knowing you got the capital, you're heavier cash, and just you're seeing how down some of these are, especially some of your beloved bios, and just start looking at them and just start researching as much as you can on them, or what's the deal?
Yeah, when there's a near-term catalyst, whether it be the end of this quarter, the end of June, or coming up in the, let's say through the end of July, yeah, I'm doing heavy duty research and digging to look for the best opportunities that are out there. Again, does it mean that I hit 100%? No, it does not. No one bats 100%. I mean, your best baseball players, they get paid $300 million contracts, bat 300, and hit a couple of dingers with a high strikeout rate. That's success in baseball. Success for me is, if I can hit 75% of these, then dude, I'm crushing it. I'm extremely happy with my success rate at that point. You just have to know when to cut them when they go the wrong direction. And I never hold through data. I don't hold through data ever. Won't do it. Been burned 9 times out of 10. It's like holding through earnings. You don't know how the market's going to react to something. And I'd rather just play the simple run up and then reevaluate it as a day trade or a couple day swing after the data presents itself. And knowing that the company probably is going to do an offering if it's a biotech at that point. But yeah, I'm definitely perking more and have taken a few more swings over the last few weeks than I had probably in the first 60 to 75 days of the beginning of the year.
Assuming you were starting to trade now as opposed to back then, what do you think you would be doing differently, in this environment to learn how to trade as opposed to what you did, and just different things you would do just coming into this market?
Yeah, back then it was really a solitary universe and on message boards, and it wasn't instant responses on Twitter or DMs or even text messages, because they cost a shitload back then to send. It wasn't free data on your cell phone. I think the things that I see today that really trouble me is everyone wants instant gratification. Trading, you can have instant gratification, but understand that the successes that you had in the beginning of the year were abnormal. And if you made money, awesome. Go pay your bills. Go pay your debts with it. Don't throw it back to the market because you're going to get chopped up, especially if you're brand new. If you think you've got this mastered after 60 days, 6 weeks, 6 months, a year, you don't. I don't have it mastered. And I've been doing this 15 years. No one has it mastered. I preached this to Hugh. I said, and then when he and I started talking in the beginning of last year, find 2 to 3 things that you trade and get really fucking good with them. And then realize you're not good after you think you're good, and just keep doing it over and over and over again. And then dip your toe into the pool with real capital. I think new traders are so, they feel this need that they have to just start cranking out heavy gains in the beginning. You don't. I mean, if you want to survive in this game, just take it easy. The market's always going to be here, but man, if you blow up and that's all you have, then
you won't be here, but the market will.
You won't. Yeah, the market's going to keep cranking, man, but you're just going to be left in the dust as a bag of bones. Just my advice is take it easy. Go if you really are hell bent on putting capital in the market because you're I got to get out of this pattern day trading. Dude, do it super small dollars. Just test it. Just test it out. Just go easy. But again, find 1 to 3 things that work for you, master it, realize that you haven't figured it out once you think you mastered it. And then if you think you mastered it again, you still haven't mastered it, then put some capital to work. But there's nothing wrong with day trading. Paper trading. The downside to it is you don't have any physical emotion to it because it's not real capital. So that's why I'm always like, you know what? Do a couple things, but put in minimal dollars. Do like $100. It's not going to kill you. And if $100 does kill you, you shouldn't be doing this. You need to focus on some other stuff to get your life in order.
What do you think is the benefit, like we're just talking about, of all these people like trading right now under PDT? What do you think is the benefit of all these retail traders and a potential downside that could eventually happen?
They will never come. A benefit? I don't know a benefit. I know the risk is they'll never come back to the market if they get burned. That's
one thing I was worried about is people just saying, forget their 401ks. They think they know a little bit about the market. Now they're like, everything's overextended. I'll wait. And then, it just keeps cranking.
Yeah. The benefit for me would be to teach yourself to be self-sufficient. And I think that's the benefit of this at the end of the day. Be your own boss. If this allows you to be your own boss, great. If you run a business, awesome. Don't forego running your business to day trade. In my opinion, you learn to swing trade. That's where the most money is ever going to be made for traders is swing trading. Yes, we love instant gratification. Yes, this is the universe that we live in today with Twitter and Facebook and all the social media stuff and how news and media is thrown in our face. It's all instant gratification. But if you take it easy and you learn to swing trade, the heavy dollars that you'll make in the market will be from swing trading. You will make your largest gains from swing trading. Again, though, the inherent risk, you blow up and then you're fearful of the market, and then you have a bias to the market, a negative bias, and you're going to want to come back into the market, but you're going to have a negative bias. And you can't have a bias in either direction. You've got to be non-emotional, and you've just got to be a robot. If trade works, great. If it doesn't work, great. There's no reason to celebrate or be down in one direction or the other. Just move on to the next trade. Just treat it very mechanical.
So someone sees your calls, they know not to put it all in at once, and it starts going up. It's up 20%, it's up 50%, it's up 100%. What would your advice to that trader be? He's newer, obviously take gains, but where would you recommend? I mean, every stock is different, but for just general advice to the newer guy who's taking your trades, he sees it going up, he sees the news. What do you tell that guy? When do you sell?
Yeah, so it's a good question. No one has a crystal ball and can guess the bottom or the top, bottom tick or top tick. I love all these dudes on Twitter and social media. I guess the top tick and I guess the bottom tick and I bought there and I sold there. Bullshit. You didn't. No one does. So I always just use the analogy. It's just, you're just kind of catching a wave in the middle of it. Like there's no harm in taking profit. Don't worry about and listen, I get FOMO like anyone else. I'm like, shit, I left so much on the table. Well, great. Move on from it. You took the trade, you took the profit, or you clipped the loss, and then it became a profitable trade after you clipped the loss. Well, shit, that happens to everyone. It's just, you got head faked. We all get head faked on the day trade stuff. This is the nature of the beast. But don't be fearful of taking profit. Know that you booked the gain, and know that, or if it was a loss, you got out of it really quick with a paper cut, like micro dollar loss. And that's a successful trade, to be honest with you, too. I think folks fail to look at that like, well, it was red. It wasn't successful. No, it was successful because you could have lost your head on the trade. But yeah, profit taking is up to the individual person. There are some folks that trade stuff that I do much better than I call. When I call it out, they trade it better than I do. Great. You know what? Hey, awesome, dude. Congrats. You know, it doesn't, you know, I ride the wave. I don't look for tops and bottoms. I have levels. And if, you know, I get close to the levels, then I might trim some out, but that's just a strategy that I employ. It doesn't mean that it works for the next person. I think the hard part is for the person who's under pattern day trading under 25,000 and they want to day trade one of my calls, my swing calls. Well, cool. You can do that. Great. But like, then they're like, well, where do I take profit and how do I trim out of a trade? Well, are you day trading the swing or are you taking it as a swing? And so that's a self-realization for that trader who's, you know, following my alert. You know, did you think it through before you hit the buy button? And, you know, that's, again, it's mechanics of learning how to do this.
All right. Well, I've got one more unless he wants to ask one at the end of this. And that is, what do you think was your key to longevity in the market? I mean, 15 years is a long time to be doing anything.
Never giving up, knowing, I think, where my goals were, where I wanted to be, learning new strategies and not getting set on one individual, like one or two tools in my bag. You know, I always say learn 1 to 3. Well, once you master and learn those 1 to 3, you have to now master another 1 to 3, and not forget the ones that you learned and mastered. And so, you know, for me, it's just, this offers an opportunity. But I'm a very conservative trader. I position and size appropriately for my risk tolerance. I do not go above and beyond what I'm comfortable doing. I tell people sometimes when folks go on these big runs at a blackjack table, they'll go on runs for like a few hours and they're up like, you know, tens of thousands of dollars at the blackjack table. But what gets them and gets the house's money back is when they change the amount of money they put on the bet and they increase it because they get super confident.
Riding the hot hand.
Right. And then what happens to that hot hand? You rode for
The
3 or
hot
4
hand
hours.
fallacy. Yep.
It is.
We've seen The Big Short.
Yeah. So what happens? That hot hand goes cold, and within 30 minutes, you gave back 4 hours worth of your time. So it's pace yourself, scale in appropriately. If you think you have the golden egg on a trade, you don't. I promise you don't, because there's dudes sitting in a bank building in New York City that are waiting to throttle your ass. They see everything that we do. And so if you pace it correctly, you'll have longevity in the marketplace.
All right, well, that's all I've got. Hugh, you got anything?
You know, it's funny. I was talking to someone recently inside my DMs, and they had a quote from Rockefeller. Rockefeller was asked, what amount of money is enough money? And Rockefeller replied, just a little bit more. So, Bob, what is enough money?
Wow, man. That's a tough question.
It's funny because I was on the plane and I was like, and I looked out the window and I was like, damn. I was like, that is one of the, you know, I've never really thought about it. I've always thought about, you know, like, wow, I can't, you know, I'm looking forward to the day to where like I really don't have to worry about money. But do you really think that there's a number out there for you personally?
No, I don't. I mean, I've thought about that question too. I mean, it's a real philosophical question. What is enough? Because it is, what is enough, you know, food? What is enough money? What is enough this, enough that? What is not enough? You know, well, not enough means you can't survive. But then what is too much? What is excess, you know, excess? I don't know. I mean, I think it's a really tough thing to put your finger on. I think, you know, for me, it's like, when is it too much is when you lose who you are and become an asshole. I think that's, you know, and I've seen that with folks on a, you know, personal level. They've been real successful in their lives and now they're assholes. Well, it's because they have a ton of money and they think they can be, you know, whatever and act like assholes to other people. That's where I draw the line. Like, you need a self-check. You know, I always say, don't forget. I think I tweeted this the other day. Never forget where you came from. Never forget your roots. never forget the work that you put into getting to where you are, because if you do forget it, then you've made too much of one thing. And you know, with my family, I preach that all the time. Like, I don't care what we have. Let's not forget what we came from and how hard it was for us to get here and how quickly it can be taken away. So to answer your question, you know, what's enough? I don't know what's enough. I know when you act like a dick and an asshole, then it's enough. So kind of beating around the bush on the answer, because I don't think there's a really right way to say it, but that's just my angle and my viewpoint to it.
So 125 million.
Yeah, about 120, 155. I think I'm good.
All right, man. Well, that's all for me. And, you know, obviously this is a very anticipated. People have been wanting this for a while, so thank you for taking the time to do it with us.
Oh, thanks for having me, guys. I appreciate it.
Yeah, man. And enjoy your plans tonight, and I guess we'll see you tomorrow.
Absolutely. Have a good one,
All
guys.
right, take care.